It's early morning on Wednesday, December 31st, 2025. While most people are thinking about New Year's Eve plans, I'm staring at something that should be making headlines everywhere but isn't. The global machinery that prices precious metals just suffered what I can only describe as a silent heart attack. And no one is talking about it. My name doesn't matter, but my background does. I've been analyzing commodities markets and stacking physical silver for 12 years. I'm not a YouTuber. I'm a trader who uses this AI avatar because when something this urgent happens, I don't have time to set up lights and cameras. I built this channel because I got tired of watching fake news pump out silver hype through AI scripts while the real story was being buried, and I was tired of waiting 12 hours for mainstream outlets to report what I could already see happening in real time on my Bloomberg terminal. So here's what I'm seeing right now and why you need to understand this before the market opens. Notice the lack of panic in the headlines. Notice the strange mechanical price drops on your charts. This isn't a market move. This is a coordinated execution. The narrative is already being written for you. They're going to tell you that sanity has returned to the silver market. They'll frame the entire 2025 rally as a speculative bubble that's finally popping, because supposedly the dollar is stable and everything is fine, but that's not what's happening. What's actually happening is that the House just realized they were about to lose the entire casino. They didn't beat the traders on fundamentals. They simply changed the rules in the middle of the game to save themselves from what looks like a total physical default. The price on your screen is officially a lie. And by the end of this morning, we might be watching the greatest decoupling in modern financial history. We're talking about a scenario where the paper market and the physical market split into two completely separate realities, each with their own pricing mechanisms, their own supply and demand dynamics, and their own ultimate destinations. But that's not even the worst part. The worst part is that most retail investors won't understand what happened until it's too late to position themselves properly. Here's my thesis, and I'm going to prove it to you with the math, the mechanism, and the real-world data points in just a moment. The CME group has triggered what I call the nuclear option. By hiking margins for the second time in a single week, they've engaged in what I can only describe as margin warfare, designed specifically to break the upward momentum of silver, platinum, and palladium. This isn't about managing risk in any traditional sense. This is about forcing the longs to liquidate because the physical vaults are, from everything I can see in the data, effectively empty. Or at minimum, they're so depleted that the system cannot handle even a moderate percentage of contract holders standing for physical delivery. Today, I'm pulling back the curtain on the liquidity-only trading trap. I'm going to explain the exact mechanism behind these margin hikes, run the math on the $7,500 per contract tax that just hit overnight, walk through the real-world implications for traders holding positions right now, and share my personal battle plan for the next 48 to 72 hours. If you understand why they're doing this, you'll realize that the red on your screen isn't weakness. It's not capitulation from retail investors who suddenly got scared. It's a signal of extreme distress at the clearinghouse level. It's the sound of a system that is running out of physical metal and needs to slam the brakes on price discovery before the entire fractional reserve structure collapses. Let me show you the numbers I was looking at a few hours ago from last night, Tuesday, December 30th, 2025, at 11 p.m. Eastern Standard Time. Silver spot price, $72.05, down 4.28% on the session. Gold spot price, $4,340.54. Basically flat, up 0.02%. Gold is holding steady while silver gets crushed. Platinum, $1,999.55, down 6.18%. Another industrial precious metal getting hammered alongside silver. And here's the key data point that most people are going to miss. The DXY, the US dollar index, 98.01, sitting sideways at multi-month lows. Now stop and look at that constellation of data for a second. The dollar isn't spiking. The dollar isn't rallying. The dollar isn't doing anything that would justify a 4 to 6% dump in precious metals. Typically, when metals drop hard, it's because the dollar is rising and making dollar-denominated commodities more expensive for foreign buyers. That's the inverse correlation everyone expects. That's Finance 101. But here, the dollar is flat, dead flat, barely moving. Yet silver and platinum are being absolutely hammered. So if it's not the dollar, what's driving this? That's the question you should be asking right now. Let me show you what's happening on the ground in the physical market, because this is where the real story lives. In Singapore, Bullion Star, one of the most reputable physical dealers in Asia, just issued a 5,000 Singapore dollar minimum order limit. That's roughly $3,700 US dollars. The reason they gave, quote, extreme unprecedented demand. They are literally trying to stop small retail buyers from purchasing physical metal by pricing them out of the market entirely. Think about that for a second. A dealer doesn't impose a minimum order size because demand is weak. They impose it because demand is so strong they can't keep up with order flow. and they need to ration their remaining inventory to larger clients. Now let's go to Dubai. This is where it gets really interesting. While COMEX paper silver sits at $72, unverified reports from multiple sources in the Dubai physical market are showing silver trading at $95.05 per ounce. Let me say that again, because this number is absolutely critical to understanding what's happening. Paper silver on the COMEX, $72 per ounce. Physical silver in Dubai, $95 per ounce. That's a $23 premium. That's a 32% premium over the paper price. In a functioning, healthy market, that spread should not exist. Arbitrage traders would immediately buy paper, stand for delivery, ship the metal to Dubai, and sell it for the premium. That arbitrage would close the gap within days, if not hours, but that's not happening. Which tells me one of two things is true. Either the arbitrage traders can't get delivery from the COMEX, or the logistics and time required to get that metal from New York to Dubai are so constrained that the premium persists. Either way, it's a massive red flag. Now let me show you the price action over the last 48 hours, because the chart tells a very specific story. Look at the volatility from December 29th to December 30th. You see that V-shaped pattern? Silver spiked to $84, got slammed down to a support level around $68.35, bounced hard, and now it's being pinned down in the low 70s by what appears to be regulatory force, not organic selling pressure. That's not normal price discovery. That's intervention. The screen price is falling while the street price is exploding. That disconnect is the entire story. So why would the exchange force this? Why would the CME deliberately engineer a sell-off when physical demand is at all-time highs? Let me explain the mechanism, because once you understand how this works, everything else clicks into place. This is called liquidity-only trading, or margin-induced forced liquidation. And if you understand this concept, you'll never look at a margin hike the same way again. Here's the simple definition. Liquidity-only trading occurs when an exchange raises the cost of holding a position so fast and so aggressively that traders are forced to sell their contracts, not because the underlying asset lost value, not because fundamentals changed, but simply because they don't have the cash to cover the new margin requirements on that position. It has nothing to do with the asset as intrinsic worth and everything to do with the trader as cash flow and access to liquidity. Let me give you an analogy that makes this crystal clear. Imagine you're at a casino. You're at a $10 minimum blackjack table, and you're on a massive winning streak. You've been playing for hours, you're up significantly, and you're feeling great. The cards are running in your favor. Other players at the table are watching you, maybe even copying your bets. Suddenly, the pit boss walks over. He taps you on the shoulder and says, "New rules. The minimum bet at this table is now $1,000 per hand. And by the way, you need to prove you have $50,000 in cash in your pocket right now, or you have to leave the table immediately. You didn't lose the hand because the dealer had better cards. You didn't lose because you made a bad play. You didn't lose because the odds shifted against you. You lost because the house raised the cost of admission to a level you couldn't afford in that moment. You're forced to leave the table and forfeit your winning momentum, even though you were playing perfectly and the game itself hadn't changed. That's exactly what's happening in the silver market right now. The CME is draining the speculative fuel from the market by making it financially impossible for a huge number of traders to hold their positions. It doesn't mean the world wants less silver. It doesn't mean sentiment has shifted. It doesn't mean the fundamentals have deteriorated. It means the world can no longer afford the leverage to buy silver on the CME at these margin levels. And here's the critical insight. By making it impossibly expensive to hold a long contract, the CME is effectively bailing out the naked shorts. The bullion banks and institutional players who sold contracts they can't deliver on, who are now facing the nightmare scenario of having to go into the physical market and buy metal at these elevated prices to satisfy delivery requests. The margin hike gives them an escape hatch. It forces retail longs to liquidate, which drives the paper price down, which allows the shorts to cover at artificially suppressed levels. Now, let me show you the math on this, because this is where the true scale of what's happening becomes undeniable. According to CME Notice Number 25-399, which was published late last night, silver maintenance margins are jumping from $25,000 per contract to $32,500 per contract. That's an increase of $7,500 per contract. Now, $7,500 might not sound like a massive number to some people, but let's put this in context. That's an extra $7,500 in cash that you need to have sitting in your account for every single silver contract you hold. Not to open new positions, not to add to your winners, just to maintain what you already have, just to sit still. This is the overnight tax. This is the cost the CME just imposed on anyone who dared to be long silver into year-end. Let's run a stress test on a hypothetical small fund or aggressive retail trader. If you're holding 1,000 contracts, which is not an unreasonable position size for a small commodity fund or a well-capitalized individual trader, you now need to find $7.5 million in liquidity by the end of today just to keep your positions open. $7.5 million. By close of business today, in cash. If you don't have it, you're forced to liquidate. The system will automatically start closing your positions. You don't get a choice. You don't get an extension. You don't get to call your broker and work something out. You sell, or the exchange sells for you, and here's the part that should make your blood run cold. This is the second margin hike in 7 days. The first hike came on December 23rd, right before the holiday weekend, when most traders were traveling or with family and weren't paying close attention. That hike brought maintenance margins from around $20,000 up to $25,000. Now, just 1 week later, we're seeing another 30% increase, from $25,000 to $32,500. We're looking at a cumulative margin increase of roughly 50% in a single week, from $20,000 to $32,500 in 7 days. Now, let me ask you a question. If this were really about standard volatility management and prudent risk controls, why didn't they hike margins when silver was at $40 or $50 or $60? Why wait until silver hits $84 and physical premiums in Dubai explode to $23? The answer is obvious. This isn't proactive risk management. This is reactive panic. The math doesn't support the narrative of a healthy market correction driven by normal volatility controls. The math supports the narrative of a rigged casino changing the rules mid-game because the house is broke and can't pay out the winners. Now, I know exactly what the skeptics are going to say. I've already seen these arguments circulating on Twitter, in the comment sections of other channels, in the mainstream financial media. The standard line goes something like this. This is just prudent risk management. Exchanges are required by law to raise margins when volatility spikes to prevent a clearinghouse collapse. Silver just had a 150% year-to-date gain. A 15 to 20% correction is healthy and necessary. This is the system working as designed. Stop being a conspiracy theorist. Now let me address that directly, because I want to steelman the strongest version of that argument before I dismantle it. It's true that exchanges have a legal obligation to maintain adequate margin levels to ensure the financial integrity of the clearinghouse. It's true that when volatility spikes, margin requirements need to increase to account for larger potential price swings and to ensure that losing positions can be closed without creating systemic risk. It's also true that silver has had an absolutely explosive move this year, and some level of correction is normal and expected after a rally of that magnitude. All of that is factually accurate. But here's my rebuttal, and this is where the narrative falls apart. If this were truly standard proactive risk management, the margin hikes would have started months ago. They would have been gradual, incremental, and predictable. Traders would have had time to adjust their position sizing, to raise additional capital, to make rational decisions about their exposure. Instead, what we're seeing is reactive and aggressive. These aren't measured adjustments. These are emergency interventions. They aren't managing risk in a neutral, systematic way. They're manufacturing a sell-off. And here's the part that nobody in the mainstream media wants to talk about. The biggest misconception out there is that margin hikes hurt the big banks, that there's some kind of punishment for the bullion banks who are short the market. That's backwards. The bullion banks are the ones who benefit most from forced liquidations of retail longs. When margin requirements spike and retail traders are forced to dump their contracts, the paper price drops. And when the paper price drops, the shorts can cover their positions at artificially lower levels. The banks aren't the victims here. They're the beneficiaries. This is a transfer of wealth from retail longs who built positions based on legitimate supply and demand fundamentals to institutional shorts who were caught on the wrong side of the trade and needed a bailout. Look at the chart one more time. Look at the exact timing. Notice how the price drops immediately, within minutes after the CME notice is published. This isn't a gradual shift in investor sentiment. This isn't traders waking up the next morning, reading the news, and deciding to sell. This is an algorithmic, mechanical response to capital requirements. Trading algorithms are programmed to automatically reduce exposure when margin costs spike. High-frequency trading systems see the notice, calculate the new cost of carry, and dump positions instantly to maintain their risk parameters. The price action you're seeing isn't organic. It's manufactured by the rules change itself. So let me give you a quick checkpoint recap of what we know so far, because I want to make sure we're all on the same page before I move into the forward-looking analysis. Point 1, the CME hiked silver margins by 30% overnight. This is the second hike in 7 days, bringing the cumulative increase to roughly 50% in a single week. Point 2, physical demand is so extreme that dealers like Bullion Star in Singapore are imposing minimum order sizes of several $1,000s to ration their remaining inventory. Point 3, a $23 gap exists between paper silver on the COMEX and physical silver in Dubai. That's a 32% premium that should not exist in a functioning market. Point 4, the US dollar is flat. This entire move is happening without any meaningful change in the dollar, which means currency dynamics aren't driving this. Something else is. Those are the facts. Now let's talk about what happens next. Here's the critical question that everyone should be asking right now. What happens if the traders refuse to sell? What happens if enough market participants decide they'd rather post the additional margin and ride this out than capitulate to the exchange as rule changes? Let me tell you what I'm watching for, because the next few days are going to tell us whether this intervention worked or whether the system is truly broken beyond repair. First, watch for liquidation-only orders. This is the nuclear option within the nuclear option. For those who weren't around in 1980, let me give you the historical precedent. This is the Silver Rule 7 playbook that the exchange used to destroy the Hunt brothers. The Hunt brothers were Texas oil billionaires who tried to corner the silver market. They accumulated massive positions, and as the price spiked toward $50 per ounce, the exchange got nervous. So they implemented a rule that said traders could only liquidate positions, not open new ones. They banned new buying. That's the definition of a rigged game. You can sell, but you can't buy. How is price supposed to go up when only one side of the trade is allowed? If we see liquidation-only orders announced for silver futures, that's confirmation that this is a full-scale intervention, not just routine margin management. Second, I'm watching 3 specific technical and fundamental indicators every single hour. I've got alerts set. I've got multiple screens running. These are my tripwires. Indicator 1, the $68 support level. If silver holds $68 through the January 1st market open, the V-bottom is confirmed and the margin hike has failed to break the momentum. That would tell me that there's enough conviction among longs, enough physical buying, and enough capital flowing into the space that even a 50% margin increase in 1 week isn't enough to shake people out. That would be an incredibly bullish signal for the weeks ahead. Indicator 2, EFP spreads. That's exchange for physical. The EFP is the premium or discount for swapping a paper futures contract for physical metal. In a healthy market, that spread should be minimal, maybe $1 or $2 per ounce to account for storage and logistics costs. If the EFP spread stays above $10, and especially if it blows out to $15 or $20, that's the paper market officially decoupling from the physical market. That's the system breaking in real time. At that point, the COMEX price becomes irrelevant to anyone who actually wants to own silver. The real price is whatever you can buy physical metal for. And that's being set in places like Dubai, Singapore, and Zurich, not New York. Indicator 3, a force majeure declaration. This is the endgame scenario. Watch for the LBMA in London or the COMEX in New York to declare an inability to meet physical delivery requests on January contracts. Force majeure is a legal term that basically means extraordinary circumstances beyond our control. It's the escape clause that allows an exchange or clearinghouse to default on its obligations without technically being in breach of contract. If we see a force majeure event, if we see an exchange say, we cannot deliver the physical metal that we contractually promised to deliver, that's game over for the paper market. At that point, we're moving into a 2-tier market structure. Paper silver, the futures contracts and ETFs, will crater towards zero because nobody will trust that those instruments represent actual metal. And physical silver will go to the moon because it becomes the only real store of value in the space. That's the nightmare scenario for the system, and it's the dream scenario for anyone who's been stacking physical metal for years. So given all of that analysis, given everything I've just walked you through, what's my personal battle plan? Let me be very clear. I am not telling you what to do. I am not a financial advisor. I don't know your personal situation, your risk tolerance, your time horizon, or your goals. What I can do is tell you exactly what I'm watching in my own portfolio and how I'm positioning for the scenarios I just outlined. Trigger A. If silver dips toward $65 due to these forced liquidations, I'm looking to add physical bullion and only. I'm not touching paper. I'm not adding futures exposure. I'm not buying ETFs. I'm buying actual metal, taking delivery, and storing it in allocated, segregated vaults where I know exactly which bars are mine. I'm completely ignoring the noise on TradingView or any other charting platform. The price on the screen is a weapons-grade lie right now, and I'm not making decisions based on it. Trigger B. If the CME issues a third margin hike next week, I'm sitting on my hands. At that point, it's obvious that I'm not trading a market. I'm fighting a rigged casino that's actively changing the rules to ensure I lose. And I didn't get to where I am in this industry by fighting unwinnable battles. I will refuse to add any new futures exposure. I will not deploy additional capital into paper positions. I will wait for the dust to settle and reassess once the exchange stops moving the goalposts. Trigger C. If the EFP spread blows out past $15, I'm moving 100% of my paper holdings into vaulted, allocated physical metal. At that spread level, the paper market has lost all credibility. It's no longer a legitimate price discovery mechanism. It's a casino chip that may or may not be redeemable for actual metal when you try to cash it in. I'm not willing to take that risk. I'm converting everything to physical and accepting whatever premium I have to pay to get out of the system. The logic behind all three of those triggers is simple. I'm prioritizing ownership over leverage. In a normal market, leverage is a powerful tool. It allows you to control large positions with small amounts of capital. It amplifies your returns when you're right. But in a liquidity squeeze, in a situation where the system itself is breaking down, leverage becomes a liability. It makes you vulnerable to exactly the kind of margin manipulation we're seeing right now. In a liquidity squeeze, the man with the metal is king. The man with the contract is just an unsecured creditor standing in line, hoping the exchange has enough inventory to honor his claim. I know which one I'd rather be. This is a game of musical chairs, and the music just stopped. The question is whether you are holding a chair or a piece of paper that promises you a chair if there are any left when your turn comes. So let me bring this home with a final recap and a clear call to action. The CME just hiked margins 30% to force you to sell. Physical demand is at an all-time high. Dealers are rationing inventory. Premiums in the physical market are exploding to levels we haven't seen in decades. And the paper price is being used as a weapon against holders like you and me. Do not let a digital number on a screen dictate your understanding of physical reality. The system is breaking in real time, and you're watching it happen from a front row seat. The question is whether you understand what you're seeing and whether you're positioned to survive what comes next. If you want to understand how we got to this point, if you want to know why the Dubai premiums are the real canary in the coal mine, if you want to see the vault data that shows just how depleted the system really is, you need to watch my deep dive on the LBMA vault drain. I will link that video below. This isn't over. This is just the beginning of a much larger structural shift in how precious metals are priced and traded globally. Stay sharp, stay informed, and make sure you're holding something real when the paper finally burns.